Thank you, everybody. It is showtime. But we are thrilled to have Ray Dalio here and the former Treasury Secretary. It really is a privilege for us to spend the next half hour together, really trying to understand where the economy is right now, not just here in the United States, but globally. And that's where I want to start the conversation, which is this. The last two conversations that have taken place on this stage this morning thus far, invariably the question, I think, underlying both of those conversations is, what is a realistic economic growth rate here in the United States? We can talk about the rest of the world in just a moment, but I just wanted to start there. I know you think, both of you think about this issue pretty much all day, every day. What do you think is a real number for us to base all of these investments upon?
I'll give you a number that's, about 1.5% to 2%, something probably closer to 1.5% to 2%. But I think that the answer to the question is really why. There's only so much you can squeeze out of a debt cycle, and we're there globally. So when you can't lower interest rates anymore, we know that the power of having the effect on asset prices going up because interest rates go down. In other words, they has a present value effect that causes lower interest rates cause asset prices. We're reaching that limit. The inability to produce stimulation by lowering interest rates that makes debt service payments lower and causes spending is at a limit. The wealth gap is part of that limit. So you can't lower interest rates more materially. Maybe they go the other way. And you also are at a limited quantitative easing because the spreads are limited. In other words, the way quantitative easing works is that somebody comes in and buys an asset, the central bank, they buy a bond, they sell that bond, they want to buy something else, causes all the assets to go up. So globally, those forces that were behind are no longer behind us. So the real question I think that people should think of is, are we at the end of a long-term debt cycle? I think that Japan is one step ahead of Europe, and Europe is one step or two steps ahead of the United States, and the United States is probably two steps ahead of China in terms of a limited ability to produce stimulation to produce that kind of growth. So everybody will have a lower growth rate than we're used to.
Tim, do you have any more optimistic view on what that number could ultimately be?
I think when I left the New York Fed like ages ago, feels like decades ago, I think the Fed economists then thought the U.S. economy was a 2.25% potential growth economy, long-term potential growth. And I would say most economists today are in raised range. You have to recognize that demographics and slower productivity growth are just big, powerful secular trends, apart from the things Ray was focusing on too. And that just brings a lot of gravity to what's possible in these economies. It's like a world where people say it's a world of diminished expectations, slow growth, low return. I think the scarier things are really about politics, about the scary erosion of the pragmatic center in politics, diminished capacity to make sensible economic choices on things governments really have to do, and the erosion in the Keynesian arsenal, or the erosion in the policy tools available to help offset the effects of a next recession, a modest shock. Those two things are very consequential, very damaging, very scary things. If all we faced was a world where demographics were going to produce somewhat slower growth, but it was more stable, durable, that would be fine. But those two other things make it a little more perilous.
You brought up politics, so I'll just ask this question. Donald Trump has said that 4% is attainable. Blue sky it with me, given the numbers that you just presented. What would you have to do, or what could you do from a policy perspective to get there?
I think people have this sense that our system can't deliver anything meaningful But if you want to take a more hopeful view of the world, we're operating so far short of the frontier of what's possible in terms of sensible policy that it's possible you could, if you had a little bit better, we rediscovered the capacity for more pragmatic government, you could see some improvement in both the rate at which we grow over time and how those outcomes are distributed. But it's hard to overcome those deeper secular forces in the consequences of coming out of a long-term debt cycle and the secular pressures on demographics. So you can be optimistic that by getting closer to the frontier, what we know would work, you could get better outcomes, but they're not going to dramatically increase the rate at which we can grow over long periods of time.
Yeah, I think that there are two forces basically that you have to think about as productivity or debt and money cycles. So you're either going to get it because you make some big changes in productivity, and we could play around with how that might exist, but you're not going to have the debt cycles. You're going to have a big money cycle. The money cycle is really a question then for investors who are holding money. In other words, the central banks necessarily have to make it really bad for savers.
Which they're doing.
Which they're doing.
Very well.
In order to make it better for debtors. And so we are in a situation where everybody, they want to drive you out of cash. They want to drive you out of bonds and by making them so terrible. We have experienced not the bad returns of that yet because investors look at the price move as well as the carry. And we go through these cycles where the carry gets all the attention, right, and then you're squeezing a little bit of carry out of it, and the price is not against you. That's a dangerous situation because the carry can be disappeared in a price move of a day. And when that starts to happen, we have a risk that...
But what's the tipping point for that? And then how do you, if you're an investor in this audience or elsewhere, position yourself for that, recognizing that we've been talking about this particular issue for now many years?
Well, I think if you extrapolate, do pro forma financial statements for 5 years forward and start to look at what that would mean in terms of monetary policy and also what it means for cash flows. So if you take the ECB's policy and you say that that has to go on for 5 years, as you start to get even months into it, they can't buy the same stuff. They have to then continue to buy different things. Now start to think of the implications of that. Or take Japan, and you think, well, what can they buy and what can they do? They're starting to buy things that are going to be riskier assets and there's greater monetization. I think that as a result of that, investors, holders of assets, particularly financial assets, will start to think about alternatives. And those alternatives, when that happens, will probably have a profound effect on the nature of the market action. In other words, kind of the end to the cycle that we've been through.
You said to me when we were talking backstage, and I hope I can, that the historical parallel is 1935 to 1945. That's where we are now?
Yeah, well, you want to find an analogous period that you look to, but the 1929 period was a bubble, just like 2008. And we had a classic tightening monetary policy. We had a classic depression, 1930 to 1929 to 1932. From then you had the monetization, quantitative easing, essentially the monetization, producing of money to make up that gap. And you had the reactions after that. Then you bring interest rates down to close to zero. So now we have a situation that's where there's no interest rates hardly, and that asset prices have enjoyed the liquidity effect. And so there is no period in time, it would be the most recent period in time globally that is most analogous to the situation we're in.
Right. I want to get to the Fed, but I just have one policy question for you, a bank policy question. We talked about Wells Fargo and other things this morning here. When you think about all of the regulations that have been placed on top of the financial system, Wall Street, capital requirements, leverage ratios, what do you think that's done to the growth rate?
I think the financial system, by most measures, is dramatically more stable today because the strength of the capital cushions in the system are just dramatically thicker. And that's a valuable investment in trying to reduce the risks of further trauma from the system. And I think it's although there's a lot of muck and bad design in the regulation that came after the crisis, the pendulum tends to kind of, I don't know how to describe it, but yeah, it's a messy muck of stuff. But I think it's hard to make the argument, even if it would be nice to clean that up and make it a little bit more intelligent design in some ways. I think it's hard to make the argument outside some important pockets of the economy that it's had a meaningful negative effect on how fast we're growing. Again, I think if you're one of the great strengths of us is if you're a company in the United States today, you got an idea. It's just a great place to try to raise capital, and the diversity of ways people can finance things in this place is a great strength. That I think is better today than it was. There are some exceptions, though. I mean, if you're self-employed and relatively moderate income, it's much harder to get a mortgage, and that has some effect. And if you're small businesses in some areas, it's tough post crisis to. But I don't think that's principally the result of the undesirable features of some of the reforms. Some of it's in there, but it's not the dramatic piece.
Ray, I want to talk Fed with you. This is Mr. Volcker. He says that you have, quote, a bigger staff and produce more relevant statistics than the Federal Reserve does. So what is it that you know that the Fed might be missing?
In my humble opinion, I think that the Fed is putting too much emphasis on the business cycle and not enough on the long-term debt cycle. And I don't think they may be paying enough attention to how markets react relative to what's discounted in the curve. So we have about 50 basis points of tightening over the next 3 years priced into the curve. That affects all asset prices because all asset prices are affected by interest rates. It's the discount rate for the present value of the future cash flows. So if there's a change in those interest rates relative to discount, not only does that affect the bond market, it affects the equity market. That has a wealth effect. I don't know, and when you say they don't know, I think the Fed has different views, and some people have different views, so I wouldn't want to characterize it as a whole. But I also think they're paying attention to some of those things. But it's a risky thing to raise interest rates more than is discounted in the curve, particularly the duration of assets has lengthened. As interest rates goes down, there's a mechanical.
So when Jamie Dimon says to raise interest rates, you think that's wrong?
That's right. I think that's wrong. At this stage, the risks are so asymmetric. There's no doubt that you can slow the economy, the world economy, the U.S. economy. Tightening will work, okay? And when you look at the inflation pressures, this is a global thing. And you look at the demographics, all of those things means that the risks are so much more on the downside. If you have a downturn, like Tim is saying, if you have a downturn and you don't have that power, we've never been in a world together that has been like this, Yeah,
it's a dramatically different world. We all get used to a world before the crisis where modest shock was met with massive capacity to ease. Recessions became, shorter and shallower, more contained. I don't think there's any precedent for the world we're in today where, we're in expansion that's pretty old. It doesn't look that old, but it's old in years. And, we're in a world where bad things happen.
But the danger is that we are out of ammo at this point, and that if you don't raise rates, you're really out of ammo.
But the idea that you should raise rates to replenish the arsenal and slow the economy, that's a weird argument to make. I think that it's true to say that central banks in developed markets are much closer to the frontier of what's possible than I think any of us have ever seen. But it's not true, and I think Ray would say, it's not true that the major governments are completely out of ammunition. Certainly the United States, certainly China, certainly parts of Europe have a range of things they could do. But still, in aggregate, they are less, and it's a weaker arsenal, weaker thing than what was available to us in almost any previous period that any of us have seen or read about.
What about 1935 was the year that the term pushing on a string was invented. We are on varying degrees, closer to pushing on a string. Japan is pushing on a string. Europe is quite close to pushing on a string. The United States is closer to pushing on a string. China is a little bit farther away. Wouldn't you agree?
Yeah, and I think there are some slightly offsetting things which are good, which is that because the financial system has more capital, it's less likely to amplify a negative shock. And a given dose of monetary policy, fiscal policy, will have more power than in a system that is weaker and more fragile. That's a good offsetting thing. Also, it's also true that the basic framework of many emerging markets is a much more resilient, less fragile than it was before. That's good too, in some sense. But still, the fact that for most of the major developed economies, governments, et cetera, are so close to the frontier of what they can do is a dangerous and scary thing.
Okay, but here's the policy question. Isn't there an argument to be made that by keeping interest rates as low as they have been, they have effectively allowed Congress to not do its job? That by forcing the issue, you would force real measures to take place that actually might improve the economy on a more long-term basis.
You mean because you'll inflict more pain? I mean, how does that forcing happen?
Because it effectively becomes a prod. If the Fed is going to have low interest rates and take on the employment issue as its job, any senator and congressperson doesn't have to.
I'll leave the politics to Tim.
I don't do politics, but I think that, to be fair, I think if you ask the members of Congress what stands in the way of them finding some way to legislate things to be good for the economy, they wouldn't say the Fed's doing so much we feel no need to do anything. Their problem is they can't agree on things that make sense. They're just too far apart. The center is eroded.
On that topic, though, do you think it's worse than it was when you left Washington?
I don't know. When I was in that job, people used to come see me and say, "Gee, it seems hard. Politics are terrible." And I'd say, "It's so much worse than you think." I think today, I kind of want to think it's better than it looks. I'd like to think that as an American. I'd like to be optimistic. I'd like to think it's a little better. Can't be quite as bad as it looks. There are, principled, good, smart, capable people there who would really like to rediscover the capacity to do things. And maybe, we're a very strong, resilient country. We'll figure our way to that point again. And so I'm hoping that it's better than it looks.
Right. To the extent that Brexit has a global impact, and let's see if it does, I'm curious what you think its implications are politically, not just for the UK, but for Europe, for China, by the way, for our own politics, if you think that it matters. Do you think about these things not just from a market perspective, but from a sort of political policy perspective?
Yeah. Again, I think that populism, the wealth gap, the middle class, all of that, the nationalism, the impatience, is a global phenomenon. And again, it's very similar to like the late 30s, and that concerns me, yeah.
And then as an investor, what do you do about it?
Well, that's a complicated question, right? I mean, you diversify. You have a whole bunch of uncorrelated, diversified bets, and then you also, understand it as best you can. But you look at Europe and you say the European Union won't be the European Union a decade from now as a function of what just took place? That's a time frame that is beyond me. I couldn't answer that question. You just try to stay 6 months or 6 days ahead of what's happening, Were you? I mean, there's always issues, like there's the Italian referendum, and there's this, and there's always a drama, and that's what makes the game so great, who knows? Do you have a view on this? You've watched this.
I think that it's kind of hard to see what they end up negotiating in the wake of the referendum.
Are you surprised the numbers have not been as bad as we thought?
Well, I think it's hard to judge the impact now, but I think for Europe, the question is, does the dynamics and the fear associated, the risk associated with Brexit and what's happening in the politics of the continent, does that induce a bit more action by the governments of Europe, things that would help hold it together? Meaning, does the fear of the more negative outcome that Brexit helps frame, does that induce a little bit better policy? And does it help them take less risks? And I think that would be a good positive thing, but who knows? It's very hard to tell whether that's going to happen. But I think the significance of Brexit will depend mostly not on what happens in the UK, and really not mostly on what happens to the outcomes they ultimately negotiate, but what does it do to the incentive of the governing parties in Europe to try to do the things they need to do still to try to make the economy more better and to try to make the whole European Union more viable.
Are you a long-term bull? A bull?
How could you be a bull?
No,
I think I would just say that
a bull that the European Union is still the European Union in any meaningful time frame from now.
I would say that's a probable outcome. Just I watched them as they were looking in the abyss over and over again in that period after our crisis, and each time they sort of looked at the alternative and said, "Looks terrible. Let's see if we can keep it together." And I suspect that judgment will prevail.
Right. As we're flying around the globe real quick, China, both of you have expressed concerns about China over the years. Where are you now on China?
There are short-term concerns, such like business cycle concerns, 4 of them. And then I just want to say that the leadership in China is much more capable than is imagined. So, okay, here are the 4 concerns. They have to go through a debt restructuring. They have to go through an economic restructuring. They have to restructure their capital markets. And they have to keep an eye on the balance of payments. Those are 4 risks. Those are things that we've all had to do. The United States has essentially had 4 major debt crises. We couldn't pay our debts in 1971. I won't rattle them all off. We've restructured our economy in lots of ways. I remember when we were sad that the steel industry went, and then we made those adjustments. In terms of balance of payments issues, there are all of those issues. The important thing is how they're dealing with it. And if you really, get to know the economic leaders and understand something of their capabilities, which Tim has done, of course, very well, and I have done some too, you'd have to say they're highly capable people. And if you look at the programs that they've put together, my God, I could give you a list of the programs. It's so incredibly impressive that what they've put together. So this is manageable. This is a debt which is not in a foreign currency. I mean, the key thing is if you got a debt in a foreign currency, you're in deep trouble. If you have a debt in a domestic currency, you can manage it and pass it through. I'm not saying it's not challenging, but the idea that it's going to blow up and all of that, I think, is a very exaggerated notion. It has to be well managed, and I think it's well managed. And then when you take a longer look, like some of the innovations and the changes that they're making for the productivity of the longer run, it's going to be important. Their bad growth rate is probably going to be twice our good growth rate, in a sense. So you take a look at where they're going to be. It's going to be, it's a positive outlook.
You have a positive outlook, too? I remember when you were in that seat as the Treasury Secretary, you had made some comments about some concerns.
Oh, yeah, I mean, China's, you can't, if you talk to them, you'll see this. You can't be more worried about these risks than they are. And I think they have an exceptionally good feel for the complexity of the risks they face as they manage through this, very dangerous, messy transition they're going through. And it's going to be messy. It sort of has to be messy in some ways because they're trying to let the market play a greater role, and they're trying to introduce the possibility of defaults, and they want to have some broader restructuring of the economy. They want to reallocate economic activity. That, in some ways, has to be a messy process. And there's other things that are going to slow the economy. But they have degrees of freedom that are the envy of the world in how they do this, because they have very high savings rate, no meaningful debt in other people's currencies. They have still a relatively closed capital account. Very, very unlikely they lose control of the exchange rate. And they've got a financial system that is, is fundamentally dominated by the state and dominated by banks. And that's a system that's easier to stabilize and recapitalize and break runs than, for example, just to take a negative example, the system we faced in 2007. So they have enviable degrees of freedom, and they are a remarkably talented, experienced group of people, having benefited a lot, not just what they've been through. You know, they did a massive recapitalization of their system, 15 years ago or so? And they're doing one now, too, making some progress on that. But they got to watch all the mistakes and judgments other countries made and try to take the best of that in that period of time. So, you know, it'll be a challenging thing. As I said, it has to be messy in some ways, but they have lots of tools to manage this without going through a major crisis that will be deeply damaging, not just to them, but to the rest of the world.
Ray, industry question for you. And Tim, by the way, now that you're a capitalist, you can participate in this as well. $22.5 billion in terms of money flows has come into your firm recently. In an environment where the hedge fund business writ large has struggled across the board. As you look out at the business over the next couple of years, what do you see happening? People like Dan Loeb have talked about a washout in this business. Where does it go?
I think that the market environment will be always exciting. And the question is whether you're adding value or not. I think most importantly, whether you're going to add value in a bad time. In other words, everybody's long. You know, everybody's almost leveraged long.
Right.
That's an exposure. So I think that it depends how well you play the game, and there'll be opportunities. And the important thing is whether you also make money in the good times and the bad times when others.
Could Ray Dalio start Bridgewater today, though?
Oh yeah, I think it's it was not long. 2007, the world. 2008 had a bust. Right. We made 14.5% in 2008 when most people didn't. Our average returns were, the opportunities of volatility are there. There's a cross current right now that's going on, right? The cross current is the pushing of liquidity and all that liquidity causing asset prices to rise and so on. And then there is the low future asset prices and the volatility that lies ahead for the reasons that we're talking about. So we're in the middle of that cross current right there. The currents are going to change. Right. And so I think that there's, if there's boring, then we're in trouble.
We have just a couple minutes, and I do want to ask you one question about culture at Bridgewater, only because it's come up in the headlines repeatedly, and I want to ask you about this. FBI Director James Comey worked at Bridgewater. He was your general counsel. And when he left, he wrote something that I thought was fascinating. He said, "I love the idea of our culture of transparency and truth." But he went on to say, "The logic-based, relentless pursuit of excellence is inconsistent with the time of joy that animates me." And I thought that was so interesting because it sort of captured both sides of this. What do you think it is that's so misunderstood about the culture at Bridgewater?
Well, let me describe the Bridgewater culture in one sentence. It is to have an idea of meritocracy which pursues meaningful work and meaningful relationships through radical truth and radical transparency. So by meaningful work, like are you in a mission and together and what that's like. And the meaningful relationships is, can we be totally truthful with each other? Like, I don't think you're so good at that, or you might be wrong, or you made mistakes. And can we have that kind of conversation in a radically truthful way? And radical transparency, like we tape everything for everybody to see so that there's no spin. Okay, can you operate in an environment like that so that nothing's hidden? Because that way you'll have a real idea of meritocracy because you won't have an information imbalance. This is an unusual culture because we've sort of kept it behind the scenes, in a sense. It's largely misunderstood. Some people absolutely hate it, and some people could never work anywhere else. So that's by and large what it's like.
Fair enough. We're running out of time. Final question for both of you. If it's Thanksgiving and you're invited to dinner at what could be President Trump's house for dinner, what would you tell him?
I'll let Tim go first. He's the expert.
No, I think I'm going to take refuge in my usual place, which is to not comment on the choices of our successors. That's sort of that's sort of refuge I like. I guess I would say I would just try to make a virtue of something that I think Ray helped define. It's a good thing. It would be a good thing for us to value as a country, which is, you want people to be able to take some time and try to look at the long arc of challenge ahead of us, and trying to think about strategy to help better position to deal with those things, and try to take that long view so that as you go into the politics and the messy, ugly, terrible politics that constrain those choices, you've got to view at least an idea of what we need to be trying to do for the economy long term. And, as a country in history, we were really excellent at the really important moments at doing that. And that's really the most important thing. And I think what that ability to sort of go deeper and try to understand the forces shaping the quality of opportunity people have in this country and how we can better address those, what their government do, that takes a lot of care and thought. And it has to be done in that quiet moment where you can push the politics away. And whoever's in any of those jobs, you want them to, I don't know if that's Comey's joy. There may not be that much joy in it, but they should try to figure out a way to find that space to think about that early before they get overwhelmed by the constraints.
Tim's advice, I think, is good advice, like calm down and make sure you understand how the economic machine works. Be open-minded. But I think what scares Tim and I the most about the populism is that extremism. We don't want extremism. We don't want rush. We want to be able to understand that things are complicated. And
right. I thought your answer might be to meditate. I want to thank both of these gentlemen for a great conversation. Ray Dalio, Tim Geithner. Thank you, guys.
Thank you.
Thank you.
Bye-bye.